Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for May 29th, 2026. This was a holiday shortened week, but so much happened, I feel like I've got whiplash. Renewed U.S. military strikes on Iran, tentative progress towards a ceasefire extension, a hotter than expected inflation print, a GDP revision that surprised the downside, and another record high week for stocks. Uh, let's start by having a look at our benchmarks because we are solidly in the green this week, and that is a welcome development. 10-year Treasury yields are lower by 12 basis points to 4.45%, and the 30-year fixed mortgage rate is better by 17 basis points to around 6.58%. I'm a little pressed for time today, so we're going to focus on the primary driver of rates this week, and that is the tentative agreement between the U.S. and Iran on an extension of the ceasefire. The deal, which has not yet been signed by the president, would extend the ceasefire by 60 days and contains several important steps to reopening the Strait of Hormuz, namely, no tolls, removal of all mines, a lifting of the U.S. blockade on Iranian ports, and a relaxation of sanctions that would allow Iran to sell more of their oil on the open markets. The net of all this is that mortgage rates staged their strongest rally in 2 months, probably, and are ending the week at their best levels in at least a couple of weeks. We're still a far cry from where we were prior to the conflict, and despite the progress being made, there's actually really good reason for that. So let's get into that. An announcement of an opening of the Strait of Hormuz and lifting of the blockade is one thing, but the significant movement of ships is going to remain constrained for some time. Until there's confidence that this ceasefire is different than the previous one, which was heavy on the fire and light on the seas, insurance companies will be hesitant to cover shipments, and that would prevent boats from moving even with waterways being opened. Even when they gain enough confidence to write policy, you better believe the cost of those policies are going up. So a toll-free Strait of Hormuz is not a free Strait of Hormuz. And when and if that actually happens, it's also going to take a while for the backlog of something like 1,500 ships to clear out and allow traffic to return back to normal. All the while, these scarcities are going to persist and inflation pressures will remain. Speaking of inflation, that's another really important point not to lose sight of when considering this strong movement in rates. Core PCE came in this week in line with expectations, but it continues to move in the wrong direction. This is the number that the Fed looks at when calibrating to their inflation target of 2%. And we are now at the highest level it's been since November of 2023. Remember, the Fed battles inflation by raising interest rates. So increased inflation means a higher likelihood of a Fed hike. This is especially true given the fact that labor markets look to have stabilized over the past couple of months, and we'll get a fresh batch of jobs numbers next week. Hopefully that trend will hold. So if we really are looking at an end to this war, it should and it will result in a further rally and an improvement in mortgage rates. But the upside is going to be limited due to the renewed inflation concerns. We're also just a couple of weeks away from Kevin Warsh's first meeting as Fed chair. Any color we receive on how the FOMC is considering these inflationary factors are going to be a key point in how the markets price the likelihood and the timing of a near-term rate increase. So where does that leave us? Well, could mortgage rates get back into the 6.25 area? Perhaps, if this is actually an end to the war. But I would not hold out hope for a return to February's sub 6% rates anytime soon. That's all I got this week, folks. Have a great weekend, and we'll see you next time.